Hi, this is Sherry. So today I'm with Chris Weston.
Hello.
Because we recently have seen some bearish trend in Hang Seng and also China H shares. So we would like to have a quick discussion about the volatility and also the markets. So last week we have seen Hang Seng and H shares in a bearish market. So can you give us some background, like what caused this bearish trend?
Well, if we take a step back, I think we saw between November and early this year a 56% rally in the Hang Seng. So yeah, clearly the market was coming off a very high base. And then on the 27th of January, we started to see sellers emerge and we saw a peak in the Hang Seng. It's really been one-way traffic since that point. I think for the beginning of the year, first part of January, we saw record inflows into China through the northbound connect. And so, obviously there was a lot of capital going into China and Chinese equities, and obviously into, by way of proxy, the Hang Seng as well, to take advantage of the reopening trade, the earnings growth that was going to come from the pent-up demand kicking in. But really, as the year's gone on, into March and into April, people have been questioning that reopening trade. We've seen the data, through the April series consistently coming in below expectations, whether we're looking at the credit data and new yuan loans, that was significantly lower, whether we're looking at PPI inflation, the import numbers, which nearly dropped 8%. We've been looking at property sales, which have been very soft, new home sales, which have been quite sluggish and sanguine. And really that data has shown that reopening trade that a lot of people were positioned for has fizzled out. And ultimately we've seen a lot of capital leaving China and Chinese markets. A lot of that probably going into AI stocks in the US, which of course have been very strong. There's been other concerns, US-China relations. We've seen concerns around local government debt, usually kick up, so very old school concerns. And we've also seen stocks like Tencent coming under big pressure into about $300 as well. So yeah, all of those factors saw that big move. But certainly if you look at the fund flows, we saw a lot of people moving out of Chinese markets to take advantage of other jurisdictions and other geographies.
So in the past 3 days, we have seen some counter rally in HK50 and also China H shares. So what do you think the reason behind that? Well,
we've now seen the market pushing up for a fourth day at the moment. And I think there was a combination of two factors, Sherry. First of all is that the market had become very unloved and oversold. We can have a look at the market internals in the Hang Seng specifically here. We'd seen one company in the whole index was trading above its 20-day moving average. We'd seen 72% of stocks at one stage last week printing a new 4-week high. 40% of stocks with an RSI below 30. Well, these are very, very stretched levels in terms of those market internals. And you can look at oscillators and various factors, but then we mix it with this consistent underperformance of the data, and it was pretty clear that we were getting to a risk where we were going to see headlines around stimulus. And that unloved market has now been hit with headlines around stimulus. We've seen lots of focus on measures around the property market, as you'd expect. Not deep-rooted, broad-based stimulus, but we've seen measures there to reduce down payments on certain neighbourhoods. Agent costs have gone down a little bit there. We're seeing further extensions to the 16-point rescue plan that was announced last year. We've seen tax breaks being announced for high-level manufacturers, and of course, the big one overnight was that we've seen measures to make it cheaper and more affordable to purchase electric vehicles as well. So, we've got that stimulus, which we expect to see some credit growth coming through as well, but very targeted. It's not going to be a broad-based, throw stimulus and have significant credit creation. But we are seeing targeted stimulus, and I think that's kind of what we expect at this stage. And so that measure of targeted stimulus in a very unloved market has seen the market snap back for 3 or 4 days now, and there's a bit of momentum coming into the market. So whether it continues is obviously the thing that we're trying to assess here.
So do you think the rally will go further, or do you still like the short position here?
If I take a short-term view, and we're looking at sort of 4-hour daily charts, for example, as a sort of swing trade, I think there's probably more upside in the short term than downside risks. Obviously, we're watching that tape very closely and reacting. But I think where we're seeing the balance of risk at the moment is for further gains. We've taken out Friday's high of 19,210. And I think there's a squeeze that we can get back up to the bottom of the cloud, up to 20,000, I think is probably the short-term target. We might get as high as 20,300 would be probably where we get into this run. But that's where I'd be probably looking in the short term. Obviously, a lot now depends on what happens in dollar against the offshore yuan, the CNH. For the market to really get into those sort of targets, into those recent highs, I'd like to see some strength in the renminbi. I'd like to see money flowing into these markets through the northbound connect and good volumes as well. I think probably right now I'm taking a sort of a favourable view. I think where China becomes interesting, Hong Kong, the mainland markets, is in the second half of the year. Obviously, we're not really focused on that right now. But one of the stimulus factors that a lot of people are looking out for is monetary easing, not just fiscal support, but the idea that we could see reserve ratio requirements being cut by the banks, and they'll be able to effectively use those reserves to lend out and flood the system with a bit more liquidity. I think that would be very positive. We may see the prime rate being cut as well. So lending rates are going to go down. And I think if we were to see really strong belief that's going to happen imminently, which I think is probably more a second half story, I think that could be the rally where we're going to see big outperformance again in the Chinese markets and the Hong Kong and the Hang Seng into the second half of the year. And the way I'll be playing that is potentially through long-short strategies, being long the Hang Seng or the H shares, and maybe being short European markets or even the S&P or US 500. I think that could be a tactical play later this year. But right now we are on the path to look for monetary policy easing. If we believe that's going to come soon, then we could see some good upside in these markets.
So looking forward, what other catalysts do you have on the radar that you think could drive the sentiment and price action for Hong Kong 50 and the other markets? Yeah,
I think if you're looking at the Hang Seng specifically, we've got to take a view on Tencent because it's weighs about 10 to 12% of the market weight. And it'd be nice to see that push up into, say, 350 or so. And I think that would then support this bullish argument because it's such a big weighting. I think you're going to need to see how that trades. And we're starting to see some upside momentum build in Tencent. So that's something we are watching very closely as well. But I think in the short term, on the data front, we're going to be watching the trade balance numbers. Remember, in the April series, the import numbers were very weak, down nearly 8%. And that made us believe that domestic demand was falling away. And it was part of the reason we saw, the Hong Kong market and the Chinese equity markets under pressure. And obviously, US dollar against the CNH moved up quite sharply. So we are watching that one very closely. We're watching the import numbers specifically. It's very hard to make a forecast. But then through the week as well, we get CPI and PPI as well. And that producer price inflation is expected to worsen or deteriorate. And actually see a negative four handle effectively. Now, the question we've got is, when does bad news become good news for risk assets? In the April series, data was bad and the equity market fell off. But now we know we're in a world where stimulus is potentially coming. Does that mean that if we were to see lower inflation and actually deflation in PPI, does that mean it just accelerates the need for further fiscal measures and also monetary measures, and therefore risk assets such as the Hang Seng rallies quite sharply on the back of that? The other one which I'm watching this week is new yuan loans and aggregate financing and the credit data, M2 money supply. And again, that could give us an idea of if banks have been lending a bit more and there's new money being put into the system as well. So I think that's the issue. As I said, in the April series, bad data meant that we saw outflows from Chinese funds and a weaker yuan. The question now, which we're looking for, is have we reached the other point where bad news actually becomes good news because it just increases the need for stimulus?
So we've seen increasing amount of clients trading on Hang Seng, and also the trading volume has been increasing a lot. So what do you think the trading condition that attracts all the clients to Pepperstone?
I mean, I think the clients like range to work with, and you see at the moment the 5-day daily trading range is about 455 points or so. So there's plenty of range for day traders to work with, and obviously swing traders as well. There's plenty, but certainly on the day trading side, you've got good range relative to a lot of other markets. For more sort of swing and momentum based traders, it has been trending really well. So, we saw that in the back end of last year, a really strong one-way trend. And then for most of this year, we've seen really strong trending and momentum conditions as well. Strength, weakness has bred further weakness. But I do think as well, you've got a market which has got fantastic liquidity, pretty good costs in terms of spreads, but everyone loves the movement. And it's what we call a higher beta market. So typically when the Hang Seng would be moving, when the US 500 or the S&P would move 1% higher, the Hang Seng might move 2% higher. So people love that movement. People are attracted to movement, liquidity, costs, and trend and momentum. And I think that's where the Hang Seng really has it in spades.
Thank you, Chris.
Thank you, Sherry.